Hey everyone, thanks so much for joining us. We normally get started about a minute or two after, but we're going to take that minute or two to tell you about a fundraiser that we are doing. If you haven't heard of Catalyst Cares, we often do different fundraisers throughout the year. We did a food collection earlier this year where we donated cans to the Houston Food Bank, and now we've teamed up with the Houston Food Bank again. Every $1 that you donate provides 3 meals to families in need. We've made it a little fun. We decorated 2 small Christmas trees in our office, so you get the opportunity to vote for your favorite tree, just to keep things lively. But every time that you donate $1, you give 3 meals to families in need. So if you're interested in participating in our Catalyst Cares with the Houston Food Bank, check out our Facebook event page. We just reposted it, so that should be top of the screen. We'll go ahead and start looking into our market update. We are so excited. We did a lot of research on this and worked together to bring you the best information we think will be the most helpful going into 2021 and looking over the last month. And as usual, we are going to go over our disclaimer. The presentation is for general information only. No documents or estimates presented herein represent any final determination on investment performance. Catalyst Funding and its agents, guest speakers, representatives cannot and do not guarantee any rate of return or investment profitability based on the information presented. You guys that have been with us have heard this disclaimer over and over. If you haven't yet, feel free to take a look at it on the screen, and we'll go ahead and move into who we are. If you're joining us for the first time, we do monthly market updates every month, and we cover the metropolitan areas that we lend in the state of Texas, which is Houston, San Antonio, Austin, Dallas, and Fort Worth. We're your one-stop shop for hard money and permanent financing loans. We are built by real estate investors. We've been involved in thousands of transactions. We offer you a single point of contact for all your loan products, which means when you work with someone on a hard money deal, you can actually refinance the property through them as well. And if you come back in a year, you can work with the same person. You can normally be approved for multiple loan options with just one credit pool, and pre-approval letters are provided within 24 to 48 hours. Do you guys want to take one of these slides?
Sure.
Yes.
So yeah, sure. So like Destiny was saying, first of all, thanks for attending. This is our last one of the year, and we won't see you again till 2021. So happy holidays, happy New Year. Let this miserable year be over, and onward to 2021. So we are a hard money lender. We provide conventional, non-conventional loans. A lot of our loans are unique, and they're kind of tied to the hard money. So call and talk to your loan officer about how our bridge product can kind of help you buy your rental properties and refinance them smoothly and efficiently. With rates being as low as as they have been lately, we're doing a lot of primary refis. People just wanting to lower the interest rate, or they're doing a lot of cash outs where they're getting money out of their either residence or getting money out of rental properties, because A, there's a lot of equity, as you'll see in the next couple of slides. Rate values are going up, and B, rates are really low. So we're using that opportunity to capture that equity they have to fuel buying more rental properties. We do have some programs, some non-conventional programs for FICOs as low as 500. So if you have a rental property and you'd like to get a loan and your credit score maybe isn't where you want it to be, give us a call. We can still possibly help you out. And then hard money loans, they start as low as 6.99 and 2 points. And we do have a VIP flip program as well. Those rates start at 9.99 and as low as 1 point.
Thanks, Jeff.
Sure.
And Jeff is our director of lending. He manages all the operations within Catalyst Funding, and he has over 20 years of experience. We're also joined today by Comeaux, our founder and president, who has a little bit more experience. What is 25 years now, right?
Yes, 25 years.
Wade is also a licensed mortgage, sorry, I always butcher that, and I am terrible at it. He's a licensed mortgage loan originator, real estate agent, and he's also an active investor himself. So these guys have a lot of experience, and we're going to be able to learn from them today. If you have questions, we are going to be answering questions towards the end of the presentation in the last 10 minutes. feel free to start writing those questions in, either the question box, which should be on your right or left-hand side of the screen, or the chat box. And if you have a question that myself or David, who's also on the line, can answer, we'll answer you live during the presentation. All right, guys, I'm going to go ahead and hand it over to you.
Super. So we often cover the Fannie Mae Home Purchase Sentiment Index. There was a reduction in first time that that sentiment index has dropped in some time after 3 months of increases. But the response to say home prices will increase in the next 12 months is still on the rise. And you can see whenever COVID first hit, there was a big drop. People did not know exactly what was going to happen in that February, March, April timeframe. Then it's been a steady ascent since then. Almost, we're at 28% this last month here. And that is kind of approaching where we were pre-COVID. Those numbers look to be anywhere between 30 and 34%, it looks like. So rapidly approaching that level of confidence about home price appreciation over time.
Yeah. So this, I don't know if you guys read the news articles and the interwebs. You've probably seen a lot of articles about companies moving from California to Texas. And like I said, we'll get into the numbers later, but just anecdotally, it's a great time to be investing here in Texas. I read an article a lot about why these companies are moving. It's just really expensive for their employees to live there. They have a lot more taxes and regulations. And then with the work from home model that COVID has kind of proven can work, they just don't see the need for these massive facilities in places that are just frankly not very business friendly. So as you can see on the slide, Oracle moved from California to Texas, joining Tesla and Hewlett Packard. Texas expects a flood of corporate relocations from California. That's from Fox Business. Nearly 200 companies have relocated their headquarters to Texas in the past 10 years, including 74 between 2018 and before the pandemic in 2020. Some of the companies, other than Tesla, Oracle, and HP, were Charles Schwab, AT&T, McKesson, and the PGA of America. And then there's just a quote down there. I think 2021 could very well be the biggest year of corporate expansion and relocation that the state has ever seen. So it's just all signs point to good things right now for the state of Texas, the real estate market. And this is just one of those factors. Next slide, please. Yep.
Yes, this is CoreLogic data. And as we understand it, this is just a cross section of major metros across the United States. And these gives a good indication of what's going on across the country. Houston happens to be mentioned. There are no other Texas locations, but you can see the year-over-year increases across the country are significant across the board. One of the interesting things is that it appears as though Houston is one of the lower appreciation numbers, and it is. But Texas is usually much more consistent in appreciation. It does not often have the big jumps, although Austin is in a time of extreme jump at the moment, like really big appreciation because of so many companies moving there. But usually there are not the drops either. So that is a very important factor. On the East and West Coast, you do sometimes see greater appreciation, but then big drops. Even Phoenix had really big drops in the post-mortgage meltdown back in 07, 08. And you did not see that type of price depreciation in the Texas market at that time. Much steadier growth and much less swings. Next slide.
So this was put out by Texas A&M, who they do a great job on the real estate news. We covered this slide last week, but it's nothing has changed and it seems very relevant. There's actually one little statistical change in there, but it's basically their opinions on what COVID is going to do to the housing market. And there's a lot of data in there. So if you want to jump in on any comments, feel free because it's a long slide. But the housing market, like we've been saying, will be characterized by low inventories and positive price growth. That is definitely what we've been seeing. Low inventories will be especially prevalent for homes below $300,000. Price growth will be positive due to stable demand and as the demographics hurt. Most by economic crisis are low-skilled, low-wage earners who are typically renters rather than home buyers. I did on the previous, a couple of slides ago, Wade talked about that index. It was interesting, the gap between renters and homeowners, their opinion of the real estate market has never been as wide as it is right now. So it kind of speaks to the fact that the pandemic is really affecting renters and low wage earners more so than most. Mortgage rates are expected to remain low due to monetary policy. I don't see that changing anytime soon. The refinances will slow as more lenders add more requisites and the pool of households able to refi just diminishes. You know, enough people will refinance, or there won't be any people left to refinance eventually. And this is, I think, an updated stat. The Mortgage Bankers Association reports that 2.8 million homeowners, or 5.5% of all loans, are in forbearance as of the end of last month. And we have a slide to speak to that. That number is down actually from last month. So that is a good sign. Destiny, I see you've hopped on. Grace us with your present. Is there a question or?
No, I popped in just because you were breaking up a little bit and I was going to help you out if I couldn't hear you. But once I came on, I could hear you just fine.
Excellent.
Great. Let's
next slide.
Yeah. So this is also from the Texas A&M Real Estate Report for the state of Texas. And we have some interesting information here as well. You see total Texas housing sales increased for the second consecutive month, rising 5.1%. That's a nice size jump. The Texas median home price across the state accelerated 12% year over year to a record-breaking number of 273,000. So 12% year over year, very exciting growth for the entire state. Texas months of inventory. So this means if there were no new properties put on the market, it would take 2.1 months for all the homes to be sold. And that is an all-time low for the state of Texas. You can see inventory for homes priced less than 300,000 was even less. It would only take 1.6 months to sell all that inventory. And if you guys remember, 6 months is a state of equilibrium where they think that that's a normal real estate market. So we are substantially below those numbers, and it's an indication of a very hot market. They do detail the annual price growth by several of the major metros here. Austin and Dallas rose almost 13%. San Antonio was up 10.7, Houston 10.3, and Fort Worth 9.1. So basically all the major metros 10% or right at it in this last year. So very exciting numbers. Next slide.
So single family housing construction permits, right? So this is a great stat as to kind of where we're heading and what's going on in the market. And if you look, you know, they basically use 2000. That is where the starting point. That's an index of 100. So if the 2000 was the number in 2000 was 100, then you can see, you know, Texas and the United States rising up into 2006. Mortgage meltdown happens. It plummets down to really low numbers, and it's just been steadily increasing, right, up until now, when it shot up ridiculously high. And the encouraging thing for Texas real estate investors is look at the difference from the beginning of the chart to the end of the chart with regards to the spread between the United States and Texas. Texas was always a little bit ahead. There was a little more going on in Texas as far as construction permits. But if you look at it now, it's through the roof how much more is going on in Texas relative to the United States. Like in the United States is still below that baseline of 100. So they have not even gotten back to the same level that we had in 2000. And Texas is at basically, you know, almost a 70 or 80% increase over where we were. So, you know, if you bought a house or you're buying houses in Texas in the last 2020, odds are that you're beating the national average by a good margin.
And one comment I want to make on that is it's a very logical question whenever you look and see that housing construction permits are at a comparable level to what they were before the mortgage meltdown, right? So a logical question is, does that indicate future problems because of how many homes are being built at the moment and how much prices are appreciating? And I think a very important thing to understand is much of that, much of those home sales in that time frame were built upon products which are just on the market today. Jeff and I were in the business at that time, and the standards for people to get a loan were incredibly low relative to what they are today. And we've read a few articles over the past 6 months that indicate that, the average creditworthiness of a buyer of a home today is significantly different, which lends to the fact that we will have less problems over time. We will talk about the issues going on right now with COVID, some of the unemployment, and what we think that will lead to going forward. But it is important to consider the difference of the creditworthiness of the people buying homes now versus the time before the mortgage meltdown, about 15 years ago.
Yeah.
Next slide. This is basically the same information, but broken down by city, all the major metros here. And you can see Austin really accelerating quickly, which is logical with all the major corporations moving there. Packard also moved into Houston, and you can see Houston is second at the moment, with San Antonio being about in third place, and it looks like Dallas-Fort Worth catching up recently to be in about the same zone for new construction permits. Next slide, please.
So this one's pretty interesting. This one is covering the different classes of properties. So if you look at, again, they use 2000 as a baseline of 100. So wherever the level was, that's where it was in 2000. And it's charting housing construction permits for single family versus 2 to 4 family versus 5+. So, single family is just your typical single family dwelling. 2 to 4 are your duplexes, your triplexes, and your fourplexes. And then 5+ are basically smaller apartment complexes. And if you look starting in 2000, the numbers are relatively close. You'll have some spikes here and there, like duplexes were hot for a little while, and then single family, and then apartment complexes, they bottomed out around 2010. And then if you can see, apartment complexes shot right up. Like they distanced themselves by a huge margin relative to single family and 5 units. And it stayed that way for quite some time. 2018, they kind of got close to touching. They shot right back up in 2019. But look what happened since the pandemic. And that kind of goes towards what we've been talking about over the last few months, is that we feel there's a flight to space and the suburbs. People want to, if they're living in an apartment and they can afford to buy a home, they want to buy their own home. If they live in a home and they want to get more space, maybe they're going to work from home long term, they're going to buy up and buy more space. So single family is on the rise, and 2 to 4s are as well, but the apartments are plummeting. Nobody's looking to do new construction apartments right now. It's all single family. So it's good to see those numbers in a way that, it's kind of, we feel like vindicated that our opinions are looking like that's what's happening. But very interesting to see single family and duplexes skyrocketing while the apartment complexes are nobody's building apartments right now.
Yes. Next slide, please.
Well, really quick, I just want to say, if anybody is just listening in, take a peek at this graph really quick and look at what Jeff was saying with the 5+ units, and it is just dropped. It's just a complete downward slope, and we see the 2 to 4 and the single family just right above and heading straight up. So if you haven't taken a look, please look at this graph before we move on, because this one is quite astounding.
Okay. Once again is setting a benchmark of back in 2000, 100 basically being the equalizer between Texas and the United States. And you can see Up until 2007, they were relatively steady, and then Texas began to separate. Then there was a time when they kind of moved in relative consistency, but just at different levels, right? You could see 08, 2010, 2012, and then that gap started to widen, and then it's starting to widen even more at this time, which really makes sense because of so many people moving into the area. And while the entire country on single family sales is doing pretty well right now, you can definitely see the separation between Texas and the rest of the country.
So total months of inventory. This one is not baseline. This is basically saying, okay, if you look in starting in 2007, and like Wade said, months of inventory is how long will it take to sell all of the existing properties if no new properties hit the market. So back in 2007, you know, the country was a little over 6. Texas was a little over 5, about where you'd expect, right? And then the mortgage meltdown hits. Nobody's buying property, so there's tons of inventory. And then it starts kind of slowly coming back down, and then it rapidly comes back down around 11, 12, and 13. And it kind of keeps staying low. And then again, look at how Texas has gone from, you know, right there with the United States to where it's I mean, it's down to two months. It's probably, I think it's the lowest it's ever been. It is just really difficult to find a property right now in Texas. There's a lot of competition out there. So it's just, again, the overall number is what's telling in this chart. The fact that we are so much lower than we've ever been, at least in the last 13 years.
And
Doug, I'm sorry, I missed that last bit that you said. Could you repeat it?
Sure. I was just saying that the most telling thing about this chart is the fact that if you look, it is the lowest it has ever been in the past 13 years, especially in Texas.
yes, and to talk to months of inventory again, it's really supply and demand. And whenever there's a very, very limited supply, that always pushes prices up. We're definitely seeing that at the moment. And I really don't, until these new homes come out of construction, and new construction time right now. We'll talk about that a little bit later on, but materials costs are a little bit higher. There are delays in construction because of COVID and because of just the number of properties that are being built. So that is pushing up the prices significantly on existing properties. And that's where many of our investors are focused, both on buy and hold investments and then flips. You know, that's going to be in that existing property category, which is really being bumped up right now because of the challenges in construction at the moment to turn out the properties that are under demand. So this is a very interesting chart breaking down the months of inventory by category. And it's interesting, back whenever COVID first hit and we were giving our recommendations, Jeff and I both said that while we thought you know, it was a great time to buy and holds, we were a little bit unsure about the flip market. And if we did say that if we thought flips could do well, we really thought they were going to do best in that 500,000 and below category, even that 300,000 and below category, we thought would be a real sweet spot. And surprisingly enough, that has not been the case. Really, flips at all levels have done incredibly well, despite the challenges. And you can see the months of inventory, you know, whenever you look at that number being near 16 months of inventory on 500,000 plus back in 2011, it's kind of amazing. And then those numbers are now below the equilibrium point of 6 months for those 500,000 plus properties, but still significantly above the other categories. But what's really interesting is that that 400,000 to 500,000 is really to come towards the trend line on even the 0 to 199. Like, they are really tightening. Almost everything in that category is getting very similar and definitely well below equilibrium, well below 3 at this point, which is a very positive market for people who want to flip properties.
Yeah, that is a good point. The fact that 400,000 to 500 doesn't behave that differently than 200,000 speaks to the levels of price increases we've seen in Texas. It's just not that uncommon anymore.
I will say that if something were to change in the market in previous either stabilizations where it's not appreciating as much or areas where there may be a downturn, that higher end market is usually impacted first. So that is something to keep in mind whenever you're doing flips. And if you're newer to flipping, we always encourage people to start at a little bit lower price point. The risk is less. The homes turn more quickly. The level of finish does not have to be as exacting. If you're dealing with, you know, $1 million home, the level of that is required is very, very high. So if you're starting out, we would definitely encourage you to be that lower.
Yeah, that's a good point. We don't talk about that much, but yes, anytime you've never done a flip before, I highly recommend starting low. Even if your profit expectations, they shouldn't be that high. I mean, if you make a lot of money, great, but if you're serious about this business and you want to do it long term, you know, you should almost hop into that first flip with very low risk, very low rehab, just as a learning experience to kind of learn what to do, what not to do, and then kind of gradually build over time to that level. New flippers that want to do $1 million house scare me. I would not recommend doing that at all.
Gotta walk before you can run.
See. Okay, so this one, like Wade was talking about, new builds, right? So this is a chart, the median price per square foot, and it's comparing buying a new home, buying an existing home. And, you know, it kind of goes as you would expect, right? It's a nice gradual increase. I think the interesting thing about this chart is the tail end. If you see that spike where the existing homes are closing the gap versus the new homes. And I think that kind of speaks to Wade's point earlier about they just weren't building as many new homes. I think there's a huge demand for homes. And so you're going to be less picky. If you want to move into a house, you are less picky, whether it's a new or an existing home. So I think the existing home market, I think it's going to continue to narrow for the foreseeable future.
I do think the increase is, you know, you kind of said nice. It is nice and steady, but it's about 66% since 2011, which is it's not just steady, but quite strong in my opinion. Over a 9-year period, 66% on the price per square foot. So that means, you know, your properties without having to add square footage or do any expansions have gone up a significant amount in that category. So major metros on price per square foot, not surprisingly, Austin is the leader in the clubhouse by a pretty large margin. Dallas, really, you see in that 2017, 2018 period was really starting to jump ahead. And then the progression of Fort Worth and San Antonio over Houston over time is very interesting. One of the reasons that Houston is still a great area to purchase rentals is because of that number. Rents are still really strong comparatively, while the price point is lower. But still a lot of other great areas. I still think San Antonio is a great and emerging area to buy rentals. Fort Worth as well. Does get tough and often unless you're doing some type of 2 or 4 unit. They do have a very healthy duplex and quadplex market over there. But you definitely see how these prices impact the ability to find high quality rental opportunities.
Silicon Hills.
Yeah.
I read that they calling all the people who live from Silicon Valley turning Austin to Silicon Hills.
Like the hill country is now Silicon Hills. Okay, I say catching up.
Okay, so this one is a 30-year mortgage rate. You know, if you look at that blue line, you know, it's just kind of telling. It's funny because, like, you'd think those numbers, they don't look like they're drastic movements, but when you look at it, it started in the 6s. Now it's all the way down below 3. You know, that is opportunity, is what that is. You know, the ability to get money as cheap as this is not going to last forever, I wouldn't think. So you want to hop on it while you can. You know, like I always say, it's hard to get closer. You can only go so low before you hit zero, but you can certainly go up. You know, this chart is only 13 years old, but you can creep back another 10, 20 years. You can see they were a lot higher. And, you know, those opportunities it's a lot more expensive to buy a house back then. So while you have these great opportunities to buy money cheap, I highly recommend getting in, because it's a whole lot easier to cash flow with a rate in the 3s or the 4s than it is in the 7s rates.
Yes. I think when people say, they ask us regularly, like, what do you think about buying rentals? You know, the market's been really hot lately. Sooner or later, it'll have to slow down the appreciation. And I do think that that's definitely a reasonable thought. Texas as a whole has not shown the big drops over time, but could the appreciation slow? I think that's very realistic. That said, to Jeff's point, even if they were to slow down or maybe even potentially drop, you know, the fact that you're able to get so much purchasing power through incredibly low, historically low interest rates, while you might lose a little bit of your equity capture, potentially if it happened to drop, which I still think is unlikely, but even if it did happen, your cash flow would not be impacted. Like if rates went up to 6% or 7%, to Jeff's point, you would have to get a significant discount to current prices in order to cash flow at a comparable level. So the rates really impact the viability of rentals at this moment at an incredible level.
And they're impacting the values as well. I think the lower rates are part of what's driving all of this frenzy for buying real estate. So it's good all around, for sure.
Jeff, I have to agree with you there. I know maybe not the last webinar, but the webinar before, we found information that said this is the year the millennials are purchasing for the first time, and they're around age 32 and 33. Yep. And I definitely think that the lower mortgage rates have something to do with that, especially because when that age group graduated, it was around the 2008 crisis. And so interest rates were just not something that they could even wrap their head around at that time. But now, when they're at a little bit of an older age and they're more established and they see these super low rates, they're like, this is it, let's jump in. And I think that's a big factor of what's caused the buying boom, if you will.
Yeah, I mean, it's two things. One, it's they're hitting the age where most people start buying homes, and two, I think it's the largest population group ever. I mean, bigger than all the previous groups. So a lot of people at the buying time, that's a recipe for what's going on.
All right, we'll move on.
And with rates being as low as they have been in the recent past, not as low as they are now, but it's easy to forget where rates were in the past. And whenever you see these numbers, it's really shocking. I think we looked it up once before, and I think the high there was like 18 point something percent. That was just the best conventional type government subsidied interest rate, which is, can you imagine trying to get a cash flowing rental with that type of interest rate at the moment? And it's possible no matter what the price was. And even for people acquiring homes, that was really causing a lot of malaise on home appreciation, and the economy as a whole definitely started to turn around right there in 1980, whenever a lot of changes were made to tax codes and other things like that. But you can see the steady drop over time and to where we are now, but never has it been anywhere close to where we are today. So whenever you're having pause and wondering, should I wait to see prices drop a little bit or whatever, timing the market is difficult. What is not difficult right now is to know that rates have never been this low, and it makes sense to get the cash flow while you can.
Okay, so Houston, excuse me. Houston had another good month. Single family home sales, there's a lot of data. Single family home sales increased for the 6th month in a row of 25% to almost 8,000 units sold. The days on market, which is an interesting number, days on market for single family dropped from 59 to 46. That is a pretty significant drop. Total property sales were up 28%. The volume, which if you look at the next chart, the volume was up 44% to 3.1 billion. When you have a lot more sales and a lot of those sales are a lot more expensive, you're going to get a ridiculous number like that. Single family home average was a record high, up 15% to 341. So the average single family home in Houston, 341. The median price was up 12% to 270. That is the second highest median price of all time. Single family homes, the months of inventory was 2.2. That is down from 3.6 last year, and below the national inventory of 2.5. So Houston is below the national number and dropping. Condos and townhomes, sales are up 23%. Average price is up 2%. Single family home rentals were down 11%, and the average rent was down 5.5% to $1,882. I tracked this number a little bit because I thought it was interesting, because it was down, but if you look, the past 4 months in a row, they were up. I think the previous month it was up 6%. So, the rent numbers, it's down a little bit this month, but it's pretty consistent the rest of the year, the last 6 months. And then townhome condo leases, townhome condo leases were down 4%, with the average rent up 11.5%. So year to date, I think Houston is up 9%, which is pretty impressive given the coronavirus. And like I said, it's a 2.2 month of inventory, which is a record low. We've never been that low.
So what is up 9%, Jeff? What were you specifically speaking about?
Year to date sales, just total volume, is up 9% year over year.
Yeah.
So the year's almost over. So it's going to be a record-breaking year for show.
Yeah. Which honestly was in large part built off of very few months. Give me 1 second. I have a technical difficulty.
No worries. I'll do the next one. Go ahead, Destiny.
Okay, or I could sing the Jeopardy theme song. We have alternative options.
I'm back. It just took a second.
I know how I vote.
One thing I did want to mention on the previous slide before we wrap up, to Jeff's point on the rentals, with being up 6% last month, coming down 5.5%, we're still up towards the same level it was before that month. We do need to see if it becomes a trend. Definitely the trend line says that rent rates are still going up significantly over time, but we look at this in January and see what the numbers were. So this chart is not drastically different than what we've been seeing for some time now, but there are just fewer properties available below 99,000 and 149,000. And I also think that the people who own those homes they've appreciated quite a bit, but if they're going to buy another comparable home, they're probably going to have to pay way up in price. So I think there's just not going to be as much activity in that category, on top of the fact that there are fewer. But you also see that in the other categories, there's definitely large increases. But in that category that we were a little bit nervous about earlier in the year, you can see there's a huge jump in overall sales in that 500 to 749 and the 750 plus. That's really incredible numbers year over year as far as the increase.
Yeah. Okay, so this is kind of a lot of a graphic representation of the stuff I was talking about 2 slides ago. November 19, comparing November 19 to November 20, total property sales were up 28%. The volume, like I said, that's $1 billion more in volume in a year. There are fewer active listings, which is again is a trend we've been seeing, but that with so much demand, even with the fewer listings, the houses are getting gobbled up. It obviously is not slowing down the volume. Single family home sales were up 25%, average price up 15%, median price up 12%, months of inventory down. Single family pending sales up 31%. So despite compare those 2 numbers, total active listings, you got 41,000 pending sales of 6. Now there's only 30,000 listings, but pending sales of 8. So that is, in my opinion, that is one of the most interesting stats you can look at. Next.
And here's a graph just showing, the steady ascent of home prices, the gap between the median and the average. But you can see in the recent months, it's really on an uptick overall, as the other data is shown, and we anticipate those trend lines to continue.
Yeah, this is just the number of units sold starting in 15. If you can look, trends are interesting. I mean, they're basically identical every single year. They're just kind of getting a little bit bigger. The mountain's getting bigger, but the mountain's the same shape every single year. So just kind of showing the steady growth in the city.
Yeah, and that's, we'll go back 1 second. The seasonality definitely plays in there. You can see that seasonality. You get in the summer, you get the booms, and in the winter it slows down. And that's not unlike this year. The reduction for the winter time has not been as significant, but it is always the case that it does slow down a little bit in the winter time. All right, next slide here. Jeff, we were going to, this is October data for San Antonio, but if I remember correctly, I believe the November data just came out.
Yeah, so November just came out. This data here is October, like Wade said, but if you look at these charts, and I'm looking at the data, it's not on the presentation, but the number of single family sales was up 27%. The average price in San Antonio is $311. The average price a year ago was $262. So it's a $50,000 increase year over year. That's a 20%. The median price in San Antonio was $261. Median price a year ago was $231. So again, significant increases for San Antonio for single family. As far as the residential rental, let's see that there were actually there's fewer residential rental sales, 1,000 rentals, which is a 4% decrease. The average price, the average rent in San Antonio was $1,555. Last year it was $1,471. So it's gone up 6%.
And just
go to the next one.
Yeah, just to clarify, Jeff, are you providing the November information?
Yes.
Okay, so we are providing the November information that came out today. So
Yes.
if you guys are watching at home, please disregard the graphs. We did not update them this morning.
I did just note that looking at the October data in our report, San Antonio was up 6% on the rent year over year for October. And then Jeff, sounds like you reported up 6% in November as well. So like I said, we don't know yet if Houston was just an anomaly or if there's something else going on, but San Antonio still seems to be increasing at that steady, pretty significant clip.
So this chart here that's on the screen is year to date. So the San Antonio November year to date, the sales are up 10%. The average price is up 8%. Median price up 7%. Price per square foot at $134 a square foot. Last year is $126, so the price is up. Days on market's the same, 59. It's average 59 days on market, so that really hasn't changed. Then as far as rentals go, let's see, pull that up. So the volume of rentals is up 2%, nothing crazy. The average price year to date is $1,525, which previously year was $1,489. So it's gone up a little bit, not a lot. Honestly, not a lot of change in the rental market year to date in San Antonio. It's pretty flat. And that is it.
All right. North Texas, this is kind of like the greater Dallas metro area, all North Texas there. Median price up significantly, 12.8%. Total time to close, about 85 days. You see the days on market, 46 days to get under contract, another 39 days for the transaction. Total sales up 23.4%. These are all over year over year versus November 2019. Active listings down 36%. That's a big drop, but still sells at a higher number. That's why we see that velocity. Total months of inventory, 2 months, also below the national average. Next slide, please.
So Austin, we've been talking a lot about Austin. The median sales price, 365. That is up almost 20% from last year. Closed sales, number of activity, the amount of activity up 23% last year. Days on market down to 29 days. New listings are up. Active listings are way down. So that is, like I said, if the closings are up but the listings are down, that just tells me that everything that gets listed is getting bought pretty quick. Pending sales up 32%. I'm sorry, up 23% to 3,200. I thought this last one was pretty interesting. The months of inventory, 0.9%. I'm sorry, 0.9 months. That is not a lot of inventory at all. It's down 1.2 months, which is basically half. So it's down 50% year over year, less than a month of inventory in Austin.
That's half of all the other major metros in Texas.
Yeah.
The others are
maybe
all.
I'm just astounded because it's in single digits or what, but like that's just impressive.
It is. So next we go into a glimpse into 2021. We can go 2 slides down. Diane Hale, very smart chief economist at Realtor.com, said some exciting things. She said she did not anticipate seeing the double-digit price growth of 2020. They did expect prices to continue to increase by 5% next year. Demand, if you look at that third bullet point, demand will spread throughout the year. It was a very unique year this year because of that real slowdown at the beginning of COVID, and then just an incredible pace after people started to realize it was not as dire as maybe initial reports were. And then a question that was asked of her: do you expect the trend of people moving away from urban core areas and into the suburbs to continue in 2021? Her response was, I do expect that to continue because people are looking for affordability, and they're also looking for more space. And as Jeff mentioned earlier, also looking for their own amenities, not as many shared amenities like you might have in an apartment complex. And I tend to agree with her that trend will continue next year.
Next slide, please. So this is good news. This chart is talking about the potential of a foreclosure crisis, kind of similar to what we had during the mortgage meltdown. There's very different reasons and opinions on why that will not happen. But if you look, there's 2 things to talk about. The percentage of overall forbearances is going down. If you look at May, it's all the way up to almost 8.5%. Through October, that is almost down to that is less than 6% now. So it's a 5.8. So that is a significant drop. And if you read the little blurb there, a lot of the positive forecast has to do with how the forbearances are being treated relative to how they were treated in the past. In the past, you had a forbearance plan. At the end of that forbearance plan, you're expected to catch all of the payments up at that time. So if you couldn't afford to make $2,000 a month for 6 months, then you're expected to drop 12 grand when it's over, right? So that's just highly unlikely. That is not how it's going to happen this year. So if you read this little blurb, it says you don't have to repay the forbearance amount all at once upon completion of your plan. Here's the important thing to remember. If you receive a forbearance plan, you'll have options when it comes to repaying this amount. You don't have to pay the forbearance amount at once unless you are able to do so. That is a drastic difference.
Now, one thing to keep in mind there, as I understand it, that is regarding Fannie, Freddie, or other government sponsored type loans like VA loans or FHA loans. There are some other non-subsidized type products with Wall Street money. And as I understand it, the government is not enforcing those same rules there. So you could see a little bit more in that category, but I think all of these other type of loan products, which make up definitely the large majority of overall mortgages in the United States, would have that ability to tack on payments to the end. Next slide, please. This is from the same person we were discussing earlier on Realtor.com, but it's just a nice visual representation. Estimates of home prices across the country increasing about that 5.7%. but really understanding the seasonality. We really think, you know, that trend we saw in Texas and Houston with a lot of activity in the summertime and dips in the winter, we think it's going to be a more normalized year next year with that same type of seasonality. People like to buy homes and maybe change schools in the summertime, where it's like their children get an entire year in a certain school. So we really think that that's going to bounce back in a similar fashion next year. Next slide, please.
So this is kind of a, yeah, this is a continuation of that report. Home sales going up. They predict 7% strong demand and more homes hitting the market. They think mortgage rates are going to go up a little bit to 3.4. Sure, it's possible. Again, if you look at the difference in a mortgage at 3 and 3.4 right now, it's negligible, but I guess eventually over time it would have an effect. This is kind of what Destiny was talking about earlier, the rise of millennials, no longer just dominating the entry-level market. Millennials are now taking over as the move-up buyers as they have children and need more space. So again, kind of a common theme, a rush to more space, and as people that age start having families, they will definitely want more space, and they're the dominant home buyers right now.
At the end there are two things that are addressed: COVID and the double dip recession. Thus far, we haven't seen like strong indicators of that double dip recession, but those things could continue to potentially prop up with vaccines and other positive news on the COVID front. It seems like things are moving in a positive direction, but I do believe that those things that are yet to be determined that could impact prices overall. Here you have, you know, just a synopsis. I'm really going to only hit on one thing. The home ownership rate, that 65.9 does continue to uptrend. We did see a report recently that said Texas, I think it's close to 70%, which is a rapidly growing number. And Houston, I mean, I'm sorry, Texas as a whole was below that national home ownership rate not too long ago, but that is really starting to reverse a trend, primarily because I think homes are just more affordable. It's more difficult for people to buy in some of these less affordable areas and to increase that home ownership percentage overall.
All right, so I think this is our last slide. Redfin, the 2021 housing market predictions. 14.5 million Americans will move out of town. And I think that what that means is they will move across county lines. And that is, to give you some reference, that is a very large number relative to what usually happens in the country. So these are 7 predictions they had. Number 1, mortgage rates will remain low at 3%. 2, feel free to jump in, Wade, since this is the last one. There will be more home sales than in any other year since 2006, but the price growth will slow down. 3, there will be more new homes built than in any year since 2006. I believe that. I think there was an index earlier I saw, it was like a home builders index. They had never been more aggressive or upbeat on the market for what they do. Number 4, the number of Americans relocating will be the highest it has been in 16 years, which will help the economies of 4 places like Buffalo, Cleveland, and Pittsburgh. Okay. Number 5, the home ownership rate will reach 70% for the first time since 2005. That is interesting because, like Wade said earlier, there weren't a lot of standards back then to own a home. It was pretty easy. So if we get to those levels now, with the much tighter mortgage standards, that's saying something. That's pretty good. Number 6, San Antonio, Tucson, and Tampa will be the hottest housing markets as major southern cities like Austin, Phoenix, and Miami become unaffordable. And then lastly, number 7, most home buyers will make an offer on a home sight unseen, which is very interesting.
That is very interesting. You know, we see that a lot in the investor market. Most investors that can consistently pick up properties have to do that because of the interest in these off-market deals at discounted prices. We see that quite a bit whenever we have a showing. Sometimes people come in and sweep it before we even have the showing. But very interesting that in-home buyers are going to feel that confident as well. Obviously, they'll have an option period, so there's some flexibility there, but they are wanting to lock up those properties, and just because there's so much darn competition, it's kind of unbelievable. I do think that those two numbers there, more new homes built, and more new homes, more overall home sales since that 2006 year. That was right at the end of that boom market that we had. But to Jeff's point, I feel more confident than we did at that point because just the drastic differences in credit quality. So, all right. And appraisal.
There she is.
Another thing is appraisals are far more regulated today, which I think is keeping a tighter control on that as well. There was not a lot of appraiser control back in 06.
All right, are we ready for questions?
Do it.
Fire away.
Thanks, guys. That was great information. In fact, we did have a few people just saying thanks. So if you would like to say you're welcome, now is the time. We'll start with our first question. This one is going to be, and I apologize in advance if I butcher your name.
Ooh.
Homie. I think it's Homie. Homy. And this is a great question. And this is, will you help people get loans if they've recently lost their regular job? So basically, I think they're trying to determine qualifications as an investor.
As far as an investor goes, if you've recently lost your job, there are great non-conventional products for that. A lot of folks that we know are real estate investors. They either do not qualify for one reason or the other, or they've maxed out their number of Fannie Freddie loans and they want to keep buying. So non-conventional products are a great way to do that. The rates aren't as low as they would be for a conventional loan, but they are close enough to where you can still make significant cash flow. And as we've been talking, the appreciation play is also not too bad either, because you're able to buy these properties and hold on to them for 5-10 years and see a huge jump in your values.
I'd also say that's just talking about the buy and hold strategy, but if they just want to flip properties, that's also, we do not require a W-2 job or documentable income for flipping at all. It's really based on assets and the property itself. If you have enough assets to pay those payments over time, and you have other solid indicators, good credit history and other things, or solid credit history, there's a very good possibility you'll be approved for a flip loan, and that might even supplement or replace your income over time, because we work with a lot of people who are full-time flippers as well.
Yeah. And there is a rare instance if you do not have a job, but yet you have a pretty large retirement. Give us a call. There are some people that do qualify for a conventional loan even without a job if they have a good chunk of change laying around in a retirement account. But call us, talk to the loan officer. They can kind of walk through that process.
Awesome, thanks, guys. Our next question is, what are your thoughts on new construction projects for investors at this time in Houston-based, from your perspective as both an investor and a lender? And then to be more specific, they are asking about single family and duplexes.
Yeah, I think new construction is a very good approach to investing. I do think at the moment, because of permitting, things are moving a little bit more slowly. It also can be a little bit more difficult to anticipate what prices will be whenever you get through a new construction project, because it's often a 9 to 12 month process. The current environment with slower permitting, et cetera, it might be a little bit longer than that. So a lot of our investors that are just starting out may lean more towards flips, because it's an easier process to start out with, and you have a better indication of where pricing will be whenever you're ready to sell that property. But some of our more experienced investors definitely do very well in that new construction category. And we've actually seen a lot of people, maybe they aren't doing buy and hold with new construction, but they are buying new properties to hold as a rental. So they don't have to worry about the construction. They get a tenant in immediately. They often get a warranty from the builder, and don't have to worry about repairs for the foreseeable future. So we have seen a significant uptick in that particular category.
Yeah, it's nice. You don't have to worry about repairs. I will say that you get better deals when you're not buying new construction. You're going to get more more equity captured, less out of pocket type of deal. I mean, if you're willing to go through the process of doing rehabs, it's going to be more economical, but way less headaches if you're doing new construction.
Awesome, thanks guys. And that question was from Troy. I just saw that. Hey Troy, thanks for joining us again. I'm glad you're here. If we did not answer your question, you have our information, so please email us. And our next question is from Edward. So why are duplexes better than apartments?
Well, I think that the biggest difference at the moment is that there's a flight towards space, and people are not willing to pay as much extra money for shared amenities. You know, one of the big attractions to apartment complexes pre-COVID was that, you know, you had a gym, you have a swimming pool, you have all these other things that you wouldn't have in a duplex or a quadplex, but people are not maybe quite as interested in that. Also, the duplexes are often more spacious, and with people often working from home or knowing that, you know, something may come up with their children and they need to be schooled from home, having that extra space is a priority at the moment over those shared amenities.
And just to add to that, I have a friend that works at a gorgeous luxury apartment community in downtown Houston. When she started just before COVID. They were at 95%, and now they are all the way down to right under 70%, which is crazy because that means people are breaking their leases to move. And because it's such a affluent apartment community, they just write a check, $10,000, no flinching. Okay, well, that's fine. We'll break the lease, we'll pay the rest out. And it's because they want that other space. They don't want to touch the elevator buttons as someone else, because it's not just amenity space, it's just walking in the hallway, you know, especially those that are not garden style, but have that internal hallway between each doors. So those are some of the reasons I've heard personally from apartment residents looking for more space, especially those that can afford to just break a lease and move right on into a house that they could probably end up spending a little less on with mortgage rates where they are today. So great question, Edward. I hope that we answered that one for you. Our next question is, what's the best way to estimate a single family home value? I am renting my house at a much lower rate than you mentioned for an average house.
Well, you know, one is working with a real estate agent potentially to help you out, but there are some other services that you can pay to get access to real comps to estimate the taxpayers' value of properties. We use one, Propelio is one that we happen to use, but there are some other options out there where you do not have to be a licensed agent in all these markets to get comparable sales, but that is extremely important to do. And while I do think that certain services, you know, that are out there like Trulia or other things like that give some indications of value, I would think that getting to the core comparable sales is going to provide a far better indication if you're going to be investing in real estate.
Yes.
Awesome. Great question. All right. And then this is one of our last questions. So it starts out. So any suggestions, recommendations for new investors looking to invest in the Houston market?
Recommendations? Sure. Give Catalyst a call. You want to build out your team, right? You want to build out your team. That is very important. If you're looking to do flips or buy and holds, you want to make sure you have all of your bases covered with lending. Obviously, you want to have a strategy on how you're going to find your properties. Are you going to work with a wholesaler? Are you going to sign up with an educational group? Are you going to do it on your own? Like, what is your plan to find deals? In my opinion, is a big deal. Contractor, you need to find a contractor. You need to find one that you trust. Find the one that you get references, referrals, people that have used this contractor in the past and know that they will do a good job and not rip you off. Find a good insurance company. If you want to do, I guess, want to do a lot, you could talk to property management. Some people do that, some people don't. But I would say build your team. Talk with somebody that is doing it now, whether it be a friend, a mentor, a company like ours, you know, somebody that has done real estate investing. Talk to them about your goals, what your plan is, what you want to do, and kind of craft out a plan from there.
I might
seek counsel.
That we see a lot of people over time who attend a lot of seminars and pay for education and attend these webinars, and then there are a group of people who are nervous to act, right? They're trying to time the market, or they want the perfect deal and other things like that. And you have to really consider the opportunity cost of investing that much time and energy and not ever doing deals. So I would just encourage people that appreciation's high, interest rates are incredibly low. If you ever want to overcome the mistakes of being a rookie investor, there might not be a better time or market in which to do that. So you definitely want to do your due diligence and build your team out. But I think the most important thing is to not pass up opportunities because you're nervous or afraid to act. Even if you make a mistake, I don't think it's going to be that big of a mistake, especially if you're doing a buy and hold in the first couple deals. Like you overpay a little bit or your contractors cost more, probably going to make up that difference whenever it appreciates 6% next year anyway, right?
And that was, thank you guys. I apologize. We actually have, I see 7 more questions. If anyone else asks a question after this, we won't be able to take it because we're at 1:06, so we're a little behind the time. Thank you guys for staying on with us. We are going to go ahead and move into these last few questions. This one's from Rebecca. Do you feel that the impact of the government regulations about evictions will continue into 2021?
That's a very good question. You know, there was a CDC enforced eviction moratorium through the end of December. There's not any current extension for that. There have been a few different COVID-related bills that have been proposed. Some of them did have eviction moratoriums, others did not. That is going to be something to watch. That said, in our portfolio, as an example, we've had relatively low delinquency, and I think forbearance rates are probably not drastically different than the national delinquency rates on rentals. I've heard, you know, some people at 6 to 8%. Our portfolio is a little bit below 3%. So I do think whenever you have a challenge, it is more difficult to evict at the moment. Obviously, there's a moratorium. You can get through those, by the way. It just is a process. But that is going to be a very important thing to watch. But I do believe if you were getting new people as tenants and you check your credit worthiness very closely, I do not anticipate unemployment going up from here and that many people losing their jobs from here on out, the vaccine coming and everything. So if you're buying a property that has an existing tenant in it that's not paying, I think that's a very dangerous proposition. I don't know how long that will take to rectify. But if you're getting a new property with someone who's gainfully employed and has good credit, I would feel comfortable. And we are continuing to buy. Just signed documents yesterday on a new one, so we're still continuing to buy. So I think it's a good idea to do so if you're making, you know, a well-considered decision on your tenant.
Thank you, Wade. We have another similar question, so I'll ask that one next. This one's from Marcus. Marcus, thank you for your question. I've been reading that some feel there's going to be a tsunami of foreclosures due to the forbearance accepting policy. Do you feel that it's going to be more suppressed, more in the sense of small waves? Thank you.
I would say, yeah. I mean, kind of pointing to the slide we had about three slides back. A, it's not that many people in forbearance, and B, I think the way they're treating them is so drastically different. You know, I think maybe they learned their lesson probably from the first time. So I do not expect a tsunami, maybe a few here and there. Obviously, there will be some impact for sure. Not everyone's going to rally, but I think overall it will be significantly lower than what it was in the past, and not so bad to where it will have a huge impact on the market.
I'd like to add something to Jeff's comment there. I definitely agree with him that I think you cannot overestimate how drastic a difference it is and how the forbearances are going to be handled. To Jeff's point, if you were in forbearance for 18 months, you had to make 18 months of payments. When you couldn't make a payment for 18 months, it's honestly preposterous, right? That was a bad way to do it. So it's going to be completely different this time. But the other thing is, there are going to be some people who are foreclosed upon, but there is so much demand at this moment. I'm very confident that that demand will be sopped up relatively quickly, unless it's a huge number. And it's difficult to see a huge number with the number of people who are in forbearance and the fact that they should be able to tack on the payments to the end. Right now, we have a need for properties on the market. It's not
Yes.
like come onto the market and there would not be buyers, right? There are enormous amount of willing buyers at the moment. So that's something to keep in mind as well.
There would have to be a tsunami of them to get it out of equilibrium.
Well played, sir.
Thank you.
We're gonna use that word now in
Marcus,
the
really?
office. Yeah,
Is that
you
the
just
Marcus?
yeah, he
Marcus
doesn't
with a K
really.
or a C?
Huh? C.
Is that Marcus with a K or a C? Okay, all right. Thanks,
There's
Marcus.
there's a tsunami of desserts in our
All
lunch.
right,
I don't know if you guys saw that.
guys,
Save
we
me
don't
some.
have time
Save me some.
for that. Let me, Marcus, this will be an all day thing now. Thanks. Amador, I want to thank you for your question. After reading it, I think that it would be best if a loan officer called to discuss that with you. So I will give your information to one of our LOs and have them reach out to you today, either email or phone. Matthew, same thing. That's qualifications on a specific loan product. So we're absolutely happy to help you. And because I have your email from the registration, I will give your information to one of our loan officers and they can contact you after. And then let's see. And that really ties it up there, guys. That's all of the questions that Wade and Jeff have time for today. So thank you guys so much for joining us. As always, please like and subscribe and join our social media channels so that you can be first to know about these sort of events. We also are still doing our Catalyst Cares fundraiser with our Christmas tree competition. So make sure to check that out on our Facebook and participate so we can help provide food for families in need. And guys, did you have anything you wanted to add before we close today?
Nope, I do not. Happy holidays, everybody. I appreciate you hopping on. Stay safe. See you next year.
Yes.
Wade.
Happy holidays.
Yeah,
Stay
see you next year.
Bye-bye.
All right. See you guys.